Ladies and gentlemen, good day and welcome to the Q1 FY'25 earnings conference call of Khadim India Limited, hosted by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Masum Rateria from Orient Capital. Thank you, and over to you, ma'am.
To the Q1 FY'25 earnings call of Khadim India Limited. To discuss our results, we have with us from the management, Mr. Ritik Roy Burman, the whole-time director, Mr. Inderjit Chaudhary, the CFO. They'll take you through our results of the business performance, after which we can begin the Q&A session. Before we begin the conference, I would like to mention that this conference may contain some forward-looking statements about the company, which are based on the belief, opinions, and expectations of the company as on date of this call. The actual results may differ materially. These statements are not guaranteeing the future performance of the company and involve risk and uncertainty that are difficult to predict. I will now hand over the call to the management for opening remarks. Over to you, sir.
Good evening, everyone. On behalf of Khadim India Limited, I am pleased to welcome you all to this conference call to discuss our Q1 FY'25 results. We greatly appreciate your time and interest in our company's performance. I trust that everyone has had the chance to review the financial results and investor presentation which have been made available on the stock exchange. During the recent fiscal period, our company encountered significant challenges that impacted our financial results. Inflationary pressures have strained our cost structure, while shifting consumer spending patterns have affected the demand for our products this quarter. Additionally, the uncertainty and disruptions associated with the election cycle have weakened consumer confidence and spending, putting further pressure on our sales. Furthermore, an unexpected and severe heat wave adversely affected demand for our core footwear products, particularly in several regions across the country. Despite these challenges, we remain committed to overcoming them through strategic cost management, supply chain optimization, and targeted marketing initiatives aiming at driving recovery in the upcoming quarters. We successfully maintained our margins, which stood at 47.1% for the quarter, marking an increase of 220 basis points. Looking ahead, we anticipate further improvement in our margins as key raw material prices soften. Retail sales accounted for 56.8% of our revenue in Q1 FY'25. During the quarter, we added a total of 20 stores, bringing our total store count to 878 as of Q1 FY'25. This includes 228 company-owned CO stores and 650 stores under the franchisee model. Our distribution business contributed 33.4% to revenue in Q1 FY'25. Our distribution network now includes 755 distributors as of the quarter ended June 2024. Our retail and distribution business have a presence in 27 states and 5 union territories as of FY'24. We are on track with our demerger process and have successfully obtained shareholders' approval for the same. We are awaiting some necessary approvals from the regulatory authorities, and we hope to complete this demerger process by end of this financial year. We remain confident in our long-term strategy to return to growth and deliver value to our shareholders. We believe in the strength of our brand, the loyalty of our customers, and the growth potential within the footwear market. Now moving on to Q1 FY'25 financial highlights. Quarterly performance. On quarterly performance, revenue from operations for Q1 FY'25 was at rupees 153.9 crores as against rupees 158.0 crores same period last year, down by 2.6% year-on-year. Gross margin for the quarter stood at 47.1%, up by 220 basis points year-on-year, as higher contribution from retail led to favorable product mix. The EBITDA for the quarter stood at rupees 17.4 crores, registering a degrowth of 4.8% year-on-year. Operating EBITDA margin for the quarter stood at 11.3%, down by 30 basis points year-on-year. The net profit for the quarter stood at rupees 0.7 crores, down by 60.2% year-on-year. PAT margins for the quarter stood at 0.4%, down by 60 basis points year-on-year. With this, I end my speech and open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for the moment while the question queue assembles. The first question is from the line of Deepan Narayanan from Trustline PMS. Please go ahead.
Good evening, everyone, and thanks a lot for the opportunity. So firstly, we have seen some sharp drop in retail demand last quarter. But do we see the footfalls improving in Q2, and how do we see the festival season demand coming up in Q3?
What we have seen in the month of July, it was more or less the same. But in the August, with this Independence Day celebration, there was a demand for footwear. And in the last week, there was a footfall and the sales was also good. And since this year the puja is in the first week of October, so the demand will rise in the month of September and in Diwali in month of October. So we think that after this muted sales for the first quarter, we will have a good demand for the festive season.
Okay. And why the distribution margins dropped at lower levels to 0.8% from the 4.5%?
In the EBITDA level?
Yeah.
The distribution sales was not as regard to last quarter. The sales was less compared to last quarter this year. And there was margin improvement in distribution in the gross margin, but the expenses and there was a lot of correction that has been done in this quarter, so that has led to the drop in the margin.
Okay, because even last quarter we have talked about we have taken a lot of correction in the product categories which are not margin accretive. So are we expecting margins in distribution coming back to the older levels?
Yes, ma'am. If you see the gross margin, it has improved. But there are some costs, there are some schemes that we have to pass on to the distributors that we have done in the first quarter. In the second quarter, with the improvement in sales compared to the second quarter of last year, I hope that EBITDA margin will be at the same point of what we have achieved.
Okay. Since this other segment contribution has more than doubled to 9.8%, so it was mainly to institutional sales, and what kind of margins were that?
There was not an institutional sale. There was some B2B sales to DMart, but the margin is low. Their margin is comparatively around 8 to 9% in the B2B sales, but that contributes directly to our EBITDA. And also there was some sales of the older materials, so that has increased the sales. But we are increasing our B2B sales channel. We are talking with a lot of these players where we can improve, we can have some sales through other channels also.
Okay. And the sub-brand contribution has reduced by 200 bps to 57%. So have we reached optimal levels of sub-brands, or this is one-off quarter for us?
I think this is one-off quarter because the demand was very much muted, and in the lower segment, Khadim has sold more. And in the franchisee also, we have seen especially in the BOs, the mother brand has sold more. But in the festive time, I think the sub-brand contribution will be higher.
Okay. And how has been the performance of sports and athleisure segment? What kind of contribution this brought this quarter?
Sports, we have seen around 5 to 6% has been sports sale, and athleisure we have just launched. Athleisure means garments. We have just launched in the Independence Day week, and we are seeing it's a good response we are seeing.
Okay. Thank you, sir. I'll join back to you.
Okay.
Thank you.
Thank you.
We would like to remind all the participants that you may press star and 1 to ask a question. The next question is from the line of Akhil Parekh from B&K Securities. Please go ahead.
Hi, thanks for the opportunity. So clarity on sports shoes, you said 5 to 6% was the growth during the quarter. Is that right?
Yes.
Yeah. The total contribution is around 20% of the total sales. Growth was there, especially in the women's footwear is doing very well for us. Women's footwear and the men's footwear is also lesser growth is there, but women and kids are having more growth in in sports shoes category. And athleisure wear products we have just recently launched, and let's see what happens, but it should do decently.
Sure. And 20% of the total sales or the total retail sales?
Total retail and EBO sales, franchisee and retail sales.
Okay. So is that the reason why gross margins are improving, or is it just purely because the raw material prices are softer?
It's a mixture of both the things.
Okay. And do we expect the kind of gross margins what we have done now are more sustainable in nature, both at the retail and the distribution level?
Distribution level, it is sustainable, but in the retail level, we have done analysis of the feedback from the customer, and where we have seen that specifically in the lower price point in the mother brand, the prices that means the customer who has gone out of the shop has shown some observation in MRP. So maybe we have to take some correction in the MRP for the Khadim brand, but that will be done after the festive season. In the next spring summer season, we will try to reduce some of the MRP in the mother brand.
Okay. In the past, we had alluded that sustainable EBITDA margins for retail would be somewhere around 17 to 19%. And now, that we are closer to the demerger thing, I'm sure we would have some visibility, right? What kind of EBITDA margins one should expect from the retail?
This quarter, we have in retail we have done a EBITDA margin of 16.37%.
Correct.
So we are more or less on track on that.
Yeah.
On track of 17 to 19%.
Yes.
Once the sales improve, the margin will be far more better than what we are now having.
Okay. Good to hear. Second, on the demand front, right? Like in past few quarters back, we had said, retail business we aspire to grow by 10-12%, which would be led by store expansion, FSG, and ESP. I understand macro situation is extremely challenging, and it's not just for Khadim, but across the brands we are seeing pressure on the sales. But do we have some confidence, like at least for second half, we can grow, say, at least high single digits, if not double digits, for the retail business?
So we are in track for the expansion. We have already opened stores, and but what has happened is that in the SSG we are degrowing because of macroeconomic factors. But I think in the festive quarter we think of a growth of in the single digit growth will be there, and we expect that after the economy has remained muted for so many months. We can see some demand during the festive season.
Okay. So would it be fair assessment to say that the current challenges what we have are not company specifics but more environmental led? Would that be a correct interpretation? Or
see, company level there are a lot of correction that needs to be there, but now the major challenge is the macroeconomic factor. The correction that we have taken a lot of correction, especially in the distribution business. Retail business also we are launching new product. We are doing where there is gap. We are introducing product. We have done that customer feedback survey. We are taking some necessary correction on that also. But the demand is very challenging environment that you can see from the other players' results also. Hope that if the macroeconomic thing change, we will have a good financial numbers.
Sure. And just two more questions. One is we had some receivables pending from the Punjab government. Have we recovered them completely or?
No. We are not recovered that yet, but we are in a good chance of recovering within this financial year.
In FY'25.
Yes.
And what would be the quantum for it?
It's around 32 crores. 32 crores.
Okay. And last one, demerger process. I think it's again a bit delayed, right? Like even last quarter we had highlighted that we should be done by September, but now in the opening remarks we are saying that it would be done by end of FY'25. So any specific reason?
No. We have received the shareholders' approval, so now it's in the final stage, but it's dependent on the court procedure NCLT. So we can have the demerger in the third quarter, maybe in the month of November or December.
Okay. That's all from my side, and best luck for coming back.
Thank you. We may remind all the participants that you may press star and 1 to ask a question. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is just the demand side. When we are talking about the macro environment being not supportive in Q1, the question is that what is your sense whether you are losing market share or all the other players are impacted by the same, and you are either holding on to your market share or you are gaining over them?
So in this context, I can tell that we are holding our market share. Whatever sale we have done, we are more or less in the same region. But what we are seeing that the footfall that used to be there in our store, that has reduced because there are a lot of challenges that we have faced in the first quarter that everybody has faced, and there are some correction that was needed that we have done in last year, and this year we are already doing. We have done a survey with the customer feedback also, and where the necessary correction we are doing. So we cannot say that we are losing market share, but when there is a festive like the Independence Day, in the last week of Independence Day, we have got good sales numbers. So whenever there is footfall in the market, we are getting the sales. The challenge has come that the footfall has reduced, and also there are challenges come from the e-commerce players. There are a lot of lot of stores, big stores having footwear segment. That challenge has come, but market has also evolved. So taking together, we are in the our market share has not improved, but we have not fallen in the market share. We are still in the business. We were used to sell 1 crore pair in retail. We are now selling around 75 lakh pair, and we will definitely achieve the 1 crore if the macroeconomic changes. We are doing our sales during the festive period. Whatever targets we are having during the festive, we are doing it. So that shows that the brand is still very vibrant in the customer. But when there is no festive or there is no weekends, the normal days, the footfall is down. Try to make up that also by giving new products, offering a good price, so that the volume also increases. So these factors we are taking into consideration and hope that the thing improve and our sales also increase.
That's quite helpful. And what was your average order value in Q1, and how was it trending compared to, let's say, Q4 or Q1 last year?
What? ASP?
No, average order value.
Average order value?
Order value for what? For franchisee? Or?
No, for the retail business. What was your to just get a sense that if the customer is coming in, is he or she buying a higher price?
AVB, average bill value. It will be in the range of 900 to 1,000.
And how was it trending compared to Q4 versus Q1 last year?
We were same. Last year, in the same range, 900, 920, it was like that. Now it was around 940, 945.
One area where we have seen a good traction is like we have this, we have got company-owned outlets, then we have got exclusive branded outlets, which is franchisees. And amongst the franchisee, there is another wing which is called branded outlets. So these are like mainly in the tier 4, very smaller markets. In those areas, we had around 5 to 6 months back, we had given some products which were competitively competitive in terms of price. So in that, when we are tracking that sales now, so it is showing a decent amount of growth. It's showing a good growth. The problem with that BO style of businesses, there were a lot of, because the prices had increased a lot over the last 3-4 years, so a lot of stores became inactive, but whichever remained active, and now that we are tracking the sales of these branded outlets, their sales have improved quite a bit. So, like Indrajit was saying, by offering new products, both in sub-brands and the mother brands, new designs, a new competitive pricing, I believe that if the market scenario remains good, I think we can grow. We can grow. Growth shouldn't be a challenge then.
Right. That's quite helpful. My other question was that in terms of your store count, how many of them would be store level, EBITDA level profitable versus losing money at the end of Q1?
End of Q1 doesn't show a correct picture because the Q1 sales are little on the downside. So if you compare if you see the last year's EBITDA level, we have done around store level EBITDA of 22 to 23%. And where most of the stores are EBITDA positive, which stores are not EBITDA positive, we take a call of shutting the store. So last year we have taken a call of shutting 2 stores, and out of that 1 we have closed, and another, the rental was, the landlord agreed the rental that we have offered, so we continued that store.
Right. So you're saying out of your almost 900 stores, only 2 stores were
No. We are saying our COCO. Out of the 240 stores that we had, 2 stores were EBITDA negative. So that store we took a call of shutting one store, and one we have the landlord reduced the rent, so we are continuing that store because at a lesser cost.
Okay. And what is your sense on the EBO stores or your franchise stores?
If the EBO are not profitable, they come with their problem. But whatever problem they come, we try to sort it out and try to keep the store open. And if there is problem with the EBO is not continuing, then we have come out with a model where we take on the store only the stock. We take the stock and give the EBO a commission because they are not able to properly run the business as per the company norms.
Okay. And so how many such EBOs were decommissioned last year?
Last year, this activity we have started in this financial year. So we have already approached 3 franchisee who has a good location but were not able to do correct business. One in Tejpur, one we have done in our Kolkata, and other we are sorting out the issue in one of the in the northern part of the West Bengal. So this model, what we have invented is that we are taking the good location of the EBO and carrying the model on a commission basis with the EBO.
Got it. And just last question on for your Q2, given the commentary you mentioned in your opening remarks, what kind of growth do you expect year-over-year there?
In the financial year, when we budgeted this financial year, we have expected a growth of around 10 to 12% in retail. And but first quarter was not, there was no growth, it was degrowth. So maybe this year we may land up in around 6 to 7% growth by doing a good festive year, and the third quarter also believes to be a good quarter. So we are doing our expansion, whatever expansion strategy we have done, we are on it. We are opening the stores. So I think we will be closing this financial with a growth of around 7 to 8%.
Understood. Thank you. And if I have more questions, I'll come back in the queue.
Thank you. The next question is from the line of Praneet, an individual investor. Please go ahead.
Hello, is Amar audible?
Yes, sir, you are. Thank you.
So basically, the first question is, I'm curious about the number of inactive stores that we are right now not operating or under the 800 number. So because in the DHRP, it was mentioned that around 155 out of 685 stores then were inactive. So is that the same? Is the ratio still continue today, or how is the situation?
So out of that inactive, so we have closed down lots of stores in that list. Now I think the inactive stores would be how much? Just a minute. We have 136 inactive stores.
So, but the inactive stores are included in the overall 800 number, right?
No, these inactive stores in DRHP also, they are not included in the overall numbers.
Okay, understood. So I'm curious about the omnichannel strategies we're employing, because Metro and Bata have been focusing aggressively on creating omnichannel approach. What could be the reason, and are we also pursuing the same aggressiveness, or what is the situation with our omnichannel strategy?
In all our COCO stores, we have omni channels, and we are doing it in a good way. In the franchisee also, we are trying to sort out the issues. So there would be the cost that involves in the omni channel. So maybe after the festive, we can run in the top 200 stores omni channel models in that store also.
Understood. One more thing is regarding the retail outlets, same-store sales and same-store volume growth and sales growth. Like in most of these footwear stores, there's usually the plateau of sales, right? So what is usually the sales number of mature stores that the sales growth is muted? And what is the volume growth that usually happens in these stores?
Generally, now the trend is that in the same store, we are not seeing any volume growth or a sales growth. There is a degrowth around 5 to 6% in the value. So previously, when before the COVID, the sales store growth was in the range of 4 to 5% SSG growth. But now we are seeing a SSG degrowth. So that's the reason why the sales is not improving. Once the SSG is back in track, I think the growth level will be around 8 to 9% in a financial year.
Understood. So one more curious about the introduction of apparel into our product range. Usually apparel have high inventory costs and like management is very difficult with their stock and everything. And is footwear also similar, or after introducing into apparel would be easier because even footwear, like how is the inventory situation regarding the apparel and footwear thing?
Apparel is lesser problem than footwear. In footwear, their sizes are 7 sizes are involved, but in apparel we are keeping only 3 sizes. So I don't think that would be too much constraint for us. But we are taking apparel in a very small way. We are testing it out in our store, in the big store. In small store, we don't have space to have the apparel. And maybe if it clicks, we will keep on the apparel in our store, and with the cost remaining the same, if we sell a good amount, it will increase the store level EBITDA. So mainly for improving the store level EBITDA, we have introduced this apparel and keeping at a competitive price compared to our competitors.
So what is the margin range for this? Is it higher than the footwear segment, or is it going to be low?
It is lower than the footwear segment.
Understood. So what are the sales expected during this year? Like we must have budgeted some kind of sales or have some kind of inventory, knowing that to forecast for the year, right? What is that sales number?
We have taken it in a very small way. Around 50 lakhs of inventory we have taken for this introduction, and we have launched it in around 40 to 45 stores. So we want to check how the sales pans out in this thing. Then only we will make expansion in this athleisure thing.
Okay, got it. One more thing with the footfall. So how is it usually what is the footfall to conversion ratio? Like how many when 10 customers enter, how many complete the purchase when they enter, and how many purchase more than the average order value?
Now the conversion ratio is high because compared last when pre-COVID it was around 40%, but now it's around 65 to 70%.
So what is the reason for the increase in conversion?
Reason for increase in conversion is the lower number of footfall. So now the sales
assured buyers are coming.
Assured buyers are coming. So the footfall, the conversion has increased.
Got it. And one more thing, with the demand and macroeconomic situation being a little weak, how is the unorganized sector going to play out in terms of the overall market competition? Because when we're growing, when the market was growing, we thought branded is going to take off better at a higher rate than the unorganized sector. So how is the situation remain, or how is it with the competitive forces increased? Is the competition more with another unorganized sector because of the market conditions, because they have lower price product, or how is it the situation?
So with the BIS introduction in footwear, we definitely see that the organized sector will improve, but it has not yet been, BIS has not implemented in a full-fledged manner. So once it is implemented and with the lower China import has gone down, I think in years to come, the impact of organized retailer will be higher compared to unorganized. But there will be unorganized challenge will be there. But with this implementation by the government, it will be better for the organized sector to do the business.
I understood that in the long-term basis. I'm more curious about the short-term, the next coming year, let's say. So is unorganized going to play a bigger competition than it played, let's say, last 2 years ago?
Unorganized has already played. There is a competition from the unorganized sector in the distribution business. But in the retail business, the pressure of unorganized sector is a little bit lesser. But there will be, in the short term, there will be remain, but with the steps that has been taken by the government, I think in the long run, it will reduce.
Got it. And one more thing is the subsidy.
Join the queue for the follow-up question. Thank you.
Okay.
The next question is from the line of Deepan Narayanan from Trustline PMS. Please go ahead.
Oh, thanks a lot for the opportunity again. Sir, you talked about this B2B kind of sales. So, is this outright sales to B2B or this unsold inventory can come back to us?
No, it is sold to the B2B. It is not any SOR model.
Okay. And how do you see the opportunity there? Now we are entered with DMart, you said. So, are we seeing more such opportunities, and how are we planning to scale this up?
We are trying to improve, but with the good payment terms and with no return policy, that's a challenge. But we are taking this that we will sell only to players who are good paymaster and with no return policy. Maybe in manufacturing defect we will return, but not on a SOR basis. So that will be a challenge, but we are taking this challenge and only grow this business in this model only.
Okay, and margins, what we are targeting in this business is like 8 to 9% kind of margins, right? EBITDA margins.
Yes.
Okay. And also in the retail business, so how do you see these franchisee inquiries happening as compared to pre-pandemic levels? Are we still seeing these franchisee interest levels higher?
See, franchisee interest level after the pre-pandemic with the cost of franchisee going up, it is little lesser. But we have opened last year also. We have opened around 70 to 75 franchisee. This year also we have targeted for that. So we are scouting franchisee. There are lots of new areas that are coming up, and with our model of franchisee now, some new models with FRM model that we have introduced in the northern and western segment. So there are some inquiry are there, and in eastern part we still have inquiry, but not at the same level that we have seen in the pre-pandemic level.
Okay. Thanks a lot, sir. All the best.
Thank you. The next question is from the line of Akhil Parekh from B&K Securities. Please.
Hi, thanks for the opportunity. Just one clarification on BIS. What are the timelines for implementation, or is it already implemented? And this implementation, will we see boost for domestic brands at the lower end of segment or at the higher end of segment? That's the only question.
Yeah, so BIS is especially for the smaller suppliers. The government has still given an extension till the end of this year. I mean the normal year, not financial year. So after that, let's see what the government says for the smaller suppliers, whose turnover is less, 5 crores and below. So many of our suppliers in that range, and whoever is the medium scale suppliers who have a turnover above 50 crores, they are already supplying us with the BIS marked products. So the team is fully ready for. We have actually trained our micro suppliers also, and once the government says that ki abhi se sabka lagao, then we'll start for that also. And what was the second question? I forgot. What is the second question?
That was the only question. And like from an imports perspective, we get more Chinese imports at the lower end, or it's more on the higher end?
Import we'll have to higher end imports will be there.
There are lots of in lower end. The government don't want to do the import in the lower end.
Government doesn't want you to import something which is below $3 or something, and just I mean, the number is not fixed yet, but they don't want you to import lower value products. So the higher value products can be imported. That's what it seems like. It can be imported actually from the next from now also you can import. So that is one good thing.
Okay. So what I understand is basically the lower end of footwear should benefit out of this whole exercise.
Yes.
Yes.
Okay. That's all from us. Thank you.
Thank you. The next follow-up question is from the line of Praneeth, an individual investor. Please go ahead.
Yeah. Hello. Hello. Am I audible?
Yes.
Thanks for the other opportunity. Another opportunity. So I'm curious about our increasing our brand number of brands. So basically, we created a infrastructure of creating sub brands to improve the brand rather than introduce new products. Right? Are we going to continue doing that, or are we going to take a break on that?
Sub brands, we are continuing to improve our sub brands and
we are improving the designs of the sub brands because as I have already told, we will reduce the margin in the Khadim brand, but in sub brands we'll keep the margin intact and we'll provide new designs, good quality product in the sub brands.
So are we going to increase the number of brands, or are we just going to keep the number of brands constant?
Sub brands will be at the same what we have done. Maybe in the British Worker we will come out with a website for the British Worker shoes.
Okay, got it. So how much sales do we do for British Workers? What's the
around 6 to 7% of the sales comes from British Workers.
Understood. So in terms of, like you previously mentioned that the franchisee cost has gone up after COVID. So what is one of the main primary reasons of it going up? And on top, after that, like, why don't we just reduce the cost so that we further increase our retail presence, like so more franchisees might take it? Or does the elasticity not remain with that? So can you come back to the
question? Your voice is cracking.
So I'm asking about, you told that the franchisee cost of taking a franchise has increased after COVID. So it got expensive franchisees to take a Khadim franchise. So I'm curious, why don't we put the price back on lower again so that more franchisees
I am telling the operation cost of the franchisees has increased.
Because the sales have reduced,
because
the cost has increased. Cost as a percentage has increased.
And also with the inflation coming in, the cost of rentals, the salaries, the others cost has increased. So whatever margin they were generating, operating margin. So now that margin has become a challenge because one side the cost has increased and other side the value of sales has reduced.
Got it. Understood. So how many of these franchises are unprofitable, do you know, on your level, or how is it?
See, we don't have their P&L account. Whichever franchisee is having problem, they come to us because and we try to sort out their issue by doing some marketing activities, or I have told in some franchises we have converted the franchisee into a FRM. So these type of things are there, and where I think there are some closures because of non-profitability.
Understood. So you provide the support as much as you can to franchises.
Yes.
Okay. And one more last question is regarding the demerger fact. So how are we going to split up the manpower in terms of top management for the both demerged companies? Are you going to is the management going to wear both the hats running both the companies, or are we going to onboard more people and reduce people in Khadim, or how is it going to be?
No, specifically the manufacturing and the distribution people distribution sales people will go to the demerged entity, and the management will look at both the company. So there will be no new introduction in that company at the management level.
So is the employee cost going to remain might the employee cost reduce for this company, the Khadim, which is in the retail segment, or is it still going to remain the same as a percentage?
Percentage it will remain the same because but the thing is that the distribution employee cost is little bit on the lower side compared to the retail because distribution we don't have manpower at all. The manpower is higher in retail. So the percentage-wise cost will remain the same, but the manpower that are dedicated to the distribution will go there.
Understood. So how much more investment are we planning on doing the distribution side? Because right now, I think our growth has remained subdued and we want to onboard more distributors. So what's the credit cycle like with distributors?
Distributors' credit cycle is around 45 days, and we are trying to squeeze as much money in the distribution business, and we are not going in giving more credit to the distributors in achieving the sales. Whatever sales we are achieving is with our own credit terms, and the working capital, we want to improve the working capital cycle in distribution business, and with good products and at a competitive price, we are trying to catch. We are giving lesser distributor because giving more places for them to work, so that the undercutting of prices doesn't happen in the market level.
Understood. So we're not going to infuse further capital into the distribution business, right? Or are we going to infuse further capital?
Generally, we are only having investment in molds. Development is a ongoing process, and in case if we require some machines, we purchase that, but no infrastructure or any improvement type of cost in distribution.
So, but because it's a manufacturing endeavor, so what is the maintenance capital going to look like for the distribution business?
Around 4 to 5 crores.
Okay, understood. And one more last thing is, I think we've been rebranding our old stores, right, to improve the brand sales and everything. How's that endeavor going? Are we changing our stores?
No, we are planned to renovate around 20 stores. Already we have around 7 to 8 stores already renovated, and we are in the plan. That plan that we have done of renovating 20 stores is on.
So are we seeing any immediate uptick with the renovations, or is it the same?
We have seen some immediate uptick in that after the renovation, but it's a very small time. We have to check around 4 to 5 months to see the overall impact of renovation.
Yeah, in the subsequent quarters, we'll be able to give you a more clear picture, but there is a good effect.
So, one last question regarding the company-owned and company-operated stores. So, are we planning on actively increasing the number of COCO stores, or are we going to remain at the same level?
No. We have seen in the budget we have planned for opening of 25 stores. We are in that plan. We have already opened around 8 to 9 stores. So by this year end, we will be opening 25 new stores.
Understood. So that's it from me. Thank you so much for your patience answering all the questions.
Thank you.
Thank you.
Thank you. In the interest of time, this was the last question for today's conference call. I would now hand the conference over to Ms. Masum Ratneria for closing comments. Ma'am, please go ahead.
Thank you everyone for joining us on the call today. I would also like to thank the management for sparing time and addressing the questions today. We are Orient Capital's Investor Relations to Khadim India Limited. For any query, please feel free to reach out to us. Thank you.
Thank you, ma'am. On behalf of Khadim India Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.